think back to the IPOs that you know. Okay? When companies IPO, if the reason is to raise funds, what do the founders usually do after the IPO? Do they stay around? If the founders don't stay around, right, you probably don't want to buy those companies in the first place. Now that's, there's a lot of economic theory about this when you have incidental information, when you have IPO and fundraising. When we talk about the pecking order and so on, theory, when we talk about financial strategy class, this is essentially that, right? You're selling your company and the buyer isn't sure about the quality, and then the buyers try to interpret the signal of your action. If you want to sell the company, okay, and you want to sell the company completely outright, that doesn't inspire confidence. Why the hell do you want to sell a company outright? If it's really good, why don't you keep it? And so most of the time the companies list the stock exchange, they don't sell everything, because if they sell everything, nobody wants to buy. The owners still need to keep some skin in the game to convince the shareholders that come to the company that, hey, don't worry, okay, this company isn't bad, look, I'm still here. I still share in the fate of the company as well. Right? That's a signaling mechanism. So founders, when they list in the market, when companies do IPO, historically, and companies that aren't backed by VCs, the main reason of going to the market is to raise funds. Okay? The secondary objective might be to access liquid markets. So in case they need to get some liquidity, they don't have to sell the company with someone else completely. They can sell the shares, then buy them back when the time is right. So they're not that worried about being, with the underpricing when there is when they still own a lot of the shares. But consider VCs. VCs aren't going to stick around. Right? VCs are really there to exit. So if there's underpricing, and in the IPO process, and what we haven't talked about explicitly is the IPO process, investors, public investors buy shares. The question is, where do the shares come from? We talk about fundraising. If that's the case, the company issue new shares. So the subscription money for those shares go into the company. That's what it means to be a fundraising process. But when you do an IPO public listing, sometimes company sell shares owned by existing shareholders. And you have to disclose this in the filing, but you have to read carefully to see this. Okay? Because they don't tell you explicitly. When the company come and do an IPO, they don't tell you, hey, by the way, the shares we're selling, they used to belong to these guys. You're just buying shares, okay? That's just bad PR, right? People don't do this. But you can actually do empirical analysis of this, and I have my students do this. Company IPOs that the existing founders exit, right? When they mix in the shares that they own and sell to the public investors that IPO as well. Those companies' long-term performance don't tend to be very good. Right? You can interpret this back to the theory we talk about again. The company is really good, why are you exiting right now? But back to the point, VCs are like underpricing because VCs aren't raising funds. VCs are selling shares. So if at the IPO, they're selling shares at 4.50, but the market says no, it's 13.50. Well, they just sold the shares at 4.50. They don't have any more shares to sell. That's it. You lost the opportunity to sell the share at the right price. So that's the opportunity cost that they have, right? Because they run out of shares to sell at one point in time. Their objective is to completely exit the company anyway. So VCs are like underpricing because they're exiting. So this affects their overall performance. Founders, they don't like it so much, but they're kind of okay. This is fundraising, but VCs don't like fundraising because for research, they don't have shares to sell anymore. Once they sold, that's it. So we go back to the IPO process equation. The IPO process is a bundle of many things that once you want to embark on this journey, you can't pick and choose. You have to take the whole package. Okay, underwriters will charge you fees. These fees are behind. If you look at Twitter, for example, I was going to do a case with you. If you look at Twitter, when they IPO, the underwriting fees are 12%. And 6% paid to one underwriter, 6% paid to another underwriter. I think it's Deutsche Bank, if I recall correctly. The other one might be, I think it's Bank of America, Merrill Lynch, if I recall correctly. Those are the two main underwriters. And they pay 12% to those guys. So that's the direct listing fee. And once they list, if the stock price goes up, that's another price they pay. They could have sold the shares at a much higher price. So why am I paying the investment bankers these? When if they say, hey, I'm helping you underwrite because you need to sell your company, right? You need to raise funds. So investors don't really know you. If you need to raise funds, I'm going to help you through the roadshow process. So the investors get to know you better. Imagine companies that IPO in the past, most of the time people don't know those companies. Right? So the underwriting involves a bit of marketing. But if you Twitter, when you IPO, everybody knows what Twitter is. If you Google, everybody knows what Google is. So actually the first guys who started thinking about this was Google. Okay, Google, when they look at an IPO, I think it's 2000 and something place. Right? They started questioning, hey, I'm going to do an IPO. I don't need these investment bankers, right? Because everybody knows who Google is. Everybody wants my shares. These underwriters would run the book building process. Sometimes they run it through an auction. Hey, I could just auction off my shares instead. In fact, I know much better about auction than these bankers. Because after all, my whole business model is auction. Right? The revenue model of Google is auctioning the AdWords. So they're the ones who got all this auctioning process figured out. So why not just get all these guys? Okay, and then do the IPO without relying on investment banks. Google flirted with an idea, but then they were slapped in the wrist because back then finance was very powerful. Said, no, bad Google, you can't do this. You have to go through us. So Google chose to go through the normal process. But that was the first time people started asking questions. Why do we need these investment banks? With big profile companies, the household names, people want us. So why pay you guys 10% to, do direct fees? And also I can figure out the pricing better because if I run the auction process, I can figure out what people are willing to pay for my shares. So there won't be any underpricing. I could have avoided all these two costs. But back then, they didn't go through. But then that got people started thinking, hey, but there are alternative ways for you to access the market. Because after all, these VC-backed companies, do they need to raise funds? No. Okay. Back then, Google didn't need to raise funds. Okay, WeWork may need to raise funds. I think WeWork may be an exception because they're not really profitable yet. Let's talk about Facebook, Google at that point in time. They don't need the money. They just want to be listed in the market. So if I just want this, if I just want to be in the market, are there other ways for me to access the market and bypassing all the components? I don't need fundraising. I don't need to pay all these direct and indirect fees. I just want a public listing so I can access the liquid market. And in the last couple of years, people start talking now about direct listing. Examples of companies that have gone through direct listing, Slack. Okay? You may or may not have used Slack, but the next example, I think most people know, is Spotify. Okay? Spotify listed without going through the investment banking process and without raising funds because they don't need to. Okay, they just want to sell shares in the public market. So you can think about this as the unbundling of the IPO process. Okay, back then, you want access to the market, you have no choice. IPO is the only way for you to access the market. Now there will be people who think about alternative ways, entering the market. There's lots of resources online in YouTube about this. There are lots of analysts come out and say, hey, we should support direct listing more. Okay? In one way, it makes sense. We come from the perspective of these VCs who think that these underwriters are not performing. Okay? They're just getting paid but not doing much of the work. Then you can sympathize with them. Okay? I want to leave this remark from a perspective of an investment. If you can invest in just one company out of the two, both companies in very similar business. Okay, they are offered to sell shares to you. The first company says, I'm looking to raise funds to expand the business. The company says, hey, I have these investors who want to leave the company. Would you like to buy the shares from them? Which one would you like to invest in? The first one who raises funds, the second one who says the existing investors want to leave? Up to you to decide, right? You may say, I'm willing to buy this and the investors want to leave because I have a fund mandate. Remember the VC fund has a mandate, 7 to 10 years and they have to return the capital. Remember, that mandate isn't mandatory because if this investment opportunity is very good, I can always go back to my LPs and say, hey, wait a few more years. We have a really good company on our hands. I don't think the timing right now is right, so if you're patient, stay with me for a few more years, I think you can make a lot more money. In other words, the fund that says, I really need to sell right now. If it's a really good company, you can always negotiate, extend more room. So if they could negotiate to extend the room but they don't, then what does that say about the company that's selling to you? Right? Maybe some companies have the optimal window because people are really hyped about this company right now. If I sell past this window, maybe not the right timing anymore, right? The market timing. And if you don't believe in market timing and all this is in people's hype, all you have to do is to look in the news and search the company called Long Island Blockchain. You read the news about this company? Long Island Blockchain is a company used to be called Long Island Iced Tea. Okay? It sells iced tea. It changed the name to Long Island Blockchain. It doesn't change anything, it just changes the name. Back then, everyone loved Bitcoin. You put the word blockchain in it, people love it. You know what happened once a company changed its name? Stock price goes up 5 times in one day. It doesn't change anything, it just changes the name to blockchain. If you think this is new, go back to .com era, 1990s or so. There's an academic article that says companies back then, there were many companies that changed names. For example, I could be a flower delivery company, I changed my name to Rose.com, I don't know. I added .com to my name, and then I changed the name. You know what happens to the stock price of those companies? Same thing. The day they announce they change the name to .com, stock price goes up. Just change the name, right? So if you live in a world where people buy things maybe not on what they think is worth, but what they think it means to them, then market timing presents a very real opportunity. Okay, so in bottom line, people now talk a lot about direct listing as a way for companies to access the market and say, hey, we should forget about IPO, think about direct listing instead. So think back, direct listing may be good for VCs who want to exit, but from you, as an investor perspective, would you want to put your money in the companies that go through the direct listing stage? Not sure. That's for you to think about. So these are the intricacies in the market you have to worry about when you do all these. I want to share with you some documents, some IPO documents. Back in the days, and look at the IPO documents today and see how the world has evolved and how the world has changed. Let me pull up the reading list. Okay, I'll update the reading list for you, but in in short, I've updated quite a few resources on here, so you might want to, maybe after, later on, spend time to think about exploring these. Okay. It's a crash. Oh, I hope it doesn't crash. Okay, so I have a lot of the document. So let's have a look at the classic IPO. Microsoft IPO in 1986. Okay. Now pull up maybe a couple more. Maybe this, pets.com. Maybe if you have time, I really suggest you spend time reading some of these IPO filings and see what they write. Okay. So, what I want to point you to is the kind of documents they came. Okay. Back in 1986, the IPO prospectus is about 52 pages. Okay. 52 pages sounds long, but manageable. Right? Information is as crisp as it can be. So let me write down some of the filings. Microsoft, that was in 1986, and it has 52 pages. Okay, next example, you can read that in your own time, is pets.com. Anyone came across pets.com in their experience or their family? A classic case study of an IPO. You'd like to guess, okay, about a decade later, how many pages are pets.com IPO documents? Sorry? 100, very close. 93 pages. Okay, good. Okay. Pets.com, okay, let's have a look. Okay. Pets.com looks something like this, old-fashioned typesetting, a lot of documents and details. You can read about this in your own time to explore what this is. And the reason why I say it's an interesting case study is that Pets.com is one of the companies that is most short-lived in the market. It filed in 2000, and you know what happened to around 2000, right, .com era. The company, I think, last 9 months in the stock market, and it became bankrupt. So if you bought shares in Pets.com, then you might as well just go and spend that instead, because it all becomes worthless. Okay. That's not a big point. Okay. Now let's turn our attention to the next decade, 2013, and the next high profile filing was Twitter. You have to guess how many pages there are. If we carry on the trend, right? 1986, 2000, about doubles. 2000, 2013, maybe about doubles. Actually, it's a bit more than that, 231 pages. Okay, finally, Uber, most recent. Let's have a look at how IPO documents change. Okay. This prospectus includes not just the text down here, but also includes some of the nice visuals, nice graphs to see how exponential and scalable the company is to convince investors to go and invest in the company and so on. Any guess how many pages? Sorry? 300. Close. 395. Okay? And can you imagine what kind of stuff you put in there? These are big businesses, yes, but what kind of business they do that warrants actually 395 pages? Why does a file need to be that long? What kind of information are you putting in there? I don't know. Okay? One of the interesting things is that Nowadays, you have the capability to analyze what is written in there, not just the numbers, okay, but also the mood and tone, and also the choice of language as well. I'm going to show you a video clip, see if I can switch this to the other inputs. Oh, this isn't working, so I'll just pull this out maybe. Okay, good.
The brand era ushered in the notion that inanimate objects could take on animate characteristics. Objects and companies could be personified, likable, young, cool, patriotic. Overpromise and underdeliver has become a means for access to cheap capital. We'll have 1 million autonomous Teslas on the road within 12 months, said you know who. You get fake it till you make it. The lines between charm, vision, bullshit, and fraud have become so narrow as to be one line. The MDMA of capitalism is the corporate communications executive. According to LinkedIn, there are more corporate communication personnel working for Bezos at Amazon, 969, than journalists working for Bezos at the Washington Post, 798. When firms are still searching for a viable business model, the temptation to go full yoga battle gets stronger as the truth, numbers, business model, EBITDA, need to conceal it. So we looked at the S1 language of a bunch of tech firms and made a qualitative assessment of the level of bullshit. We then looked at the performance 1 year post-IPO. We believe there's an inverse correlation that may be a forward-looking indicator for a firm's share performance post-IPO. How it works, we created a yoga battle scale from 1 to 10. 1 of 10, I'm a professor of marketing who likes dogs. 5 of 10, I'm the big dogs. 10 of 10, I'm the spirit dog that unlocks self-actualization. Some examples. Zoom, whose mission is to make video communications frictionless. This is accurate. Zoom is a video communications company that offers less friction as demonstrated by higher Net Promoter Scores of 62 versus WebEx at 6. The bullshit rating, just a 1. And the stock returns 6 months post-IPO, a whopping 122%. Spotify, whose mission is to unlock the potential of human creativity by giving 1 million creative artists the opportunity to live off their art and billions of fans the opportunity to enjoy and be inspired by these creators. Okay, sort of. It's hard to see how Celine Dion is unlocking human creativity. We give this a bullshit rating of 5. Stock return 1 year post-IPO, 9%. Peloton, their mission, on the most basic level, Peloton sells happiness. No, similar to Chuck Norris, Chrissy Brinkley, and Tony Little, Peloton, you sell exercise equipment. The bullshit rating here, 9. Stock return first day on the IPO, minus 11%. To be clear, that's a confirmation bias, which is not fair to compare one-day stock returns to 1 year. I can relate to the mix of hubris, success, and price complex that leads you to believe your business efforts deserve a vision worthy of your genius. If not to distract you and your investors from the reality of how hard it is to build an entity that takes in more money than it spends while growing. My new firm, Section 4, is going to restore the middle class. My colleagues roll their eyes so hard, I wonder if they've been coached by my 12-year-old son. Then we were NSFW Business Media or streaming MBA. We're trying to figure it out. I've come to the realization that we're not bringing joy to the universe. We are not Chipotle. God died informed me she's dating a club promoter. Huge red flag. Occasionally red flags marry each other. The Beats and Haley Baldwin. That's definitely going to work out. But anyway, some red flags here that are literally the size of Kansas. Okay, buckle up. Adam Newman, the CEO, has sold $700 million in stock. As a founder, I've sold shares to a secondary offering to get some liquidity and diversify holdings. Okay, I get it. But $750 million, this is $700 million red flags that spell words on the field of a football field at halftime that say the following: get me the hell out of the stock, but you should buy some. Gross margins are a pretty decent proxy for how good or bad a business is, and this is a shit shitty business. As the company scales, it is not reducing its costs. There is no scale here. The gross margins are terrible. Adam has several family members working in the business who make, open quote, less than 200,000, close quote. That's comforting. The ownership structure chart is similar to a hieroglyphic on a cave wall about the survival of our species. Harvest the crops when the sun is high on the horizon. Do not venture over the hills as hostile tribes live there. And, by the way, do not buy this stock. The related party section of this prospectus reads like the Trump administration. Adam owns 10 buildings, several that he's leased out to WeWork at a handsome profit.
I think this is a technical stuff. I think I showed you the wrong clip. There's a lighter clip about this at the beginning, the part one. Let's see if I can find it. Here we go. Okay, let me show you this one and then what about the last.
Cult. WeWork's prospectus has a dedication, no joke. We dedicate this to the power of we, greater than any one of us, but inside each of us. Pretty sure also Jim Jones had this mystic on t-shirts printed up with this inspiring adage. Speaking of idolatry, Adam, as in, quote, Adam, end quote, as in Newman, is mentioned 169 times, versus an average of 25 mentions for other founder CEOs in their own unicorn prospectuses. Uber CEO Dara Khosrowshahi is mentioned 29 times in their prospectus. Granted, Adam was super dreamy, sort of Argentinian polo player kind of way. He's actually Israeli. But he's not 6 times dreamier than Dara, who has this whole Omar Sharif if you went to Brown thing going on. But I digress. Second thing, nomenclature. First, let's find the hottest sector, and if you don't have the insight, IP, genius, capital code, skills, human capital, or a clue, then just borrow the words. SaaS firms trade at a multiple of revenues, yay, versus real estate firms which trade at a multiple of EBITDA, boo. So we isn't a real estate firm running desk, it's a space as a service firm, SaaS. I know, use the word technology over and over despite having little R&D and computers and that kind of stuff, and voila, we're Salesforce. Better yet, today I began calling my wife Giselle, which means I'm pretty sure I'm starting on Sunday for the clouds. 3, invented metrics. GAAP accounting standards got you down? No problem. We what the fuck. We has begun reporting community-based EBITDA, which is profitability before the BITA part of it. It's also taking out expenses, including real estate that comprise the bulk, i.e. 90% of the cost required to deliver the service. A more honest description of the metric that we is using would be EB, earnings before everything else. As someone who follows the markets and goes on TV regularly to pretend I have any idea which direction a given stock is headed, I'd like to suggest a few new metrics that we should begin reporting. EBG, earnings before gluten. EBVG, earnings before the big dog. EBEPW, earnings before equal pay for women.
Okay, I show you the clip just to give you a sense, okay, of where we have come to. In the old days, VCs and investing like this used to be a lot more rigorous. Okay? If you combine the current market environment of low interest rate, in fact even negative interest rate, and the fact that there's so much money around chasing deals, this is where we end up, right? We just invest in anything that we can, and anything that we want to believe in. But at some point, that's going to have to come to an end. Okay? At the crudest sense, venture-based investing like this has all similarity with Ponzi schemes. Okay? Those companies need to keep raising financing to survive. Then there's going to be a point that people come to realization. And I think we may have come to that point. If anything, I think the bust of rebirth is going to put some sense into people that this can't go on forever. Okay? So, I don't know, this could be the end of a long line of successful VC, I don't want to say bubble, okay, but VC craze, or it could be a new beginning of something that's more serious, God knows. But I want to leave you with this article. I already put it onto the reading list in the drive, but I suggest you take some time to read it. It's not directly related to venture capital per se, but it's more about how the world is changing, how the financial world is changing. In the old days, companies used to stay private for only a while, and then rush to the public market to raise financing. But with so much money around, the companies are able to keep private for a long, long time. this may not be a good thing, right? Because if you have to rush the public market, it's undeniable that you have to instill discipline in governance in order to qualify public money. So if you rely on private money like this, you can stay in the shadow for a long, long time. People make mistakes, but they have two options, right? Either they own up to that mistake and then write it off, or they try to find a bigger fool to drag along with them. Who knows? WeWork and SoftBank could have made the wrong decision. They could have come clean sooner and then not blow up like this. But if people like that can make mistakes, God knows who else can make mistakes. Yeah. I think VC may have mistakes, but what won't change is that now it's opened the floodgate of private equity investing. What used to be a niche in the market now is becoming a norm. And hopefully what we cover in this class will give you a taste of what that world is like, and perhaps what the world may be, what the norm of the world may be in the near future. Okay, so this is in, you're reading this, and I've done the PDF version of this already. It's a long read. It gives you a pretty good alternative view, okay, of what's going on in the world and how the financial world as we know it may not be the same anymore. Right, so thank you very much for today. I'll be writing down the instructions, okay, for the OptiGuard case next week. That'll be the last big calculations, and then after that we'll just wrap up the class. The rest will be the information sharing, and if you have anything else you want to go over, then I'm all ears. But the formal materials, we're almost